Okay. Good morning. Happy Wednesday. I can see a
Good
couple of
morning.
connecting to audio, so we're gonna let people be doing that.
Good morning.
Good morning. Okay, so today we're probably gonna have a small group because it's Wednesday and because it is the day before Thanksgiving. I kind of just wanted to give you guys an opportunity to ask any questions that you have. I know the last several weeks and months we've gone over a lot of different concepts from how do you go through with a customer, a client to build their bank? How do you build a plan? How do you convert that into the policy builds, various different financial concepts? So I wanted to give you guys the opportunity to ask any questions. I will open the floor. Just admitting some people. Okay, so we've got still got a couple of people connecting to audio. Apparently we're having some Zoom issues this morning, so we'll give people a quick minute. Can everybody hear me? Let's start with that.
Yes, ma'am.
Okay, just checking. It seems like it's taking a very long time for people to be able to connect to audio. Okay.
Right.
So yeah, so for today, we're answering questions on anything that we've gone over the past several weeks and months. So if anybody has any questions, please jump in. I know that the link that was sent out was a little ambiguous, so we're going to have people jumping on. So Keisha, I know that you had a question yesterday. Would you like to share that with the class to get the ball rolling?
Right. Yeah.
Keisha? Okay, so the question that Keisha asked me yesterday was what happens when somebody has a number of banks, and what happens when they're using them for various different things and they go to retire and they determine that they don't need that many banks? What happens? So this is actually fairly common. Let me just admit some people. This is actually fairly common that people have multiple banks, because maybe you started your first bank when you were 30 and you were only making $80,000 a year and you were single and you didn't have any children. So your bank would have been significantly smaller. But by the time you're 40 and you're making, let's say, $130,000 a year, and now you're married and maybe you have some kids, you've got two incomes coming into this. So as a family, maybe you now need a second bank or a third bank. You never know. So people have different banks for different purposes. I believe Nelson Nash had, what was it, like 11 or so banks and this one was for vacations, and this one was for new cars, and this one was for investments. He had a whole number of reasons for having them. But the long-term play out of this is that we do have the ability to turn them into reduced paid up policies. And what that means is that the death benefit still exists. You can leverage the cash value inside it. It's not growing as quickly, but you can still leverage the cash value inside it. And you're no longer inputting new premium on a monthly or annual basis. That being said, you never want to collapse the policy, because as soon as you collapse the policy, it is no longer an insurance policy, and any growth inside of it becomes taxable. Does that make sense to people?
Yes.
Okay, good. And did we have other questions?
So I had another question on that same thing you just said about Nelson Nash. So, which we know most typical people won't have as many as he had. But if you had a person like that that had at least 3, 4,
Yep.
when you're collapsing them down, do you collapse them into one, or you collapse them still individually?
You would turn them into a reduced paid up policy. So you never want to collapse the policy, because as soon as it is no longer an insurance policy, as soon as the death benefit goes away, it is any of the growth inside the policy becomes taxable.
Okay, so they still will stand alone as individual policies.
Yes.
This won't be contributing. Okay, gotcha.
Yeah, if they had 3 banks, they will still have 3 banks.
Okay, gotcha. They just won't be contributing to them. It'll just be for everything else. Gotcha.
Right. So, some people choose to contribute less into each of their banks, such that they're only paying the required premium to maintain the death benefit, because one never knows. Maybe there comes a point where they're going to want to be able to put more money into it. Or they might actually enact the benefit of being able to turn it into a reduced paid up policy, whereas they're not contributing anything anymore. But once that condition is met, you can only do that one time for any given policy. And at that point, no further premiums will be able to be accepted into that policy. So that is something to discuss with clients when they are approaching retirement, and that is something that they are perhaps thinking about doing. To make sure that they are clear that that is the case, because you have a lot of people who retire at 55, 60, get bored in 6 months and decide to do something that's maybe fewer hours or less strenuous, but they just want to do something. So now they have a lot more income that they want to save. And if they've turned their policy into a reduced paid up, they can't put it in. So that is how reduced paid up works. Does anybody else have any other questions? Today is I know I'm generally about class participation, but today is very much about class participation. I did not prepare anything. This was very much an opportunity for those that had questions to get them answered. We may not go the full hour today. So I just want to make sure that everybody has the opportunity to ask what they need to and get that answered.
Andrew, would this maybe be a good time to talk about the term policy we were talking about yesterday?
Oh, yeah, that actually might be a good thing to mention today. So a question came up about people who are not ready for a bank yet. What do you do with them? Because, these people might have kids, they might have debt, they might have a lot of things going on. So one of the things that can be done for these people is, for example, we had a client that this person already has an IUL, but they did not understand how it worked, and they were unaware at the rate at which the premium would have to increase over time to achieve their long-term financial goals. So we had run a banking concept for them, the whole life chassis with the term life rider and the paid up additions rider. But as of right now, they have too much debt to dispense with it immediately. But in the next 6 months to a year, they can get out of that debt and build up a nice little nest egg with which to start their bank. So what do we do with this person in the meantime? Because we know that they have coverage, they need coverage, and they want coverage to make sure that their family is protected in the interim. So this IUL, which they on their own decided that is not going to achieve their financial goals, is costing them a significant amount of money. But they still need the coverage. So are they going to continue to pay that significant amount of money until they get out of debt and start their own bank, and then cancel that and lose everything they put into it? That's the question. This is also a concept that can be done with somebody who has no coverage and needs it, which is something that I am putting together for a different client. So basically, what can be done with this is you start with a term life policy. For example, Foresters has a 10-year term that at any time in the first 5 years is fully convertible to a whole life product, which includes the banking build because it has the availability of all of the riders. So as long as the whole life portion of the banking build is less than the term life that they are originally applying for, it is fully convertible. There might need to be a little bit of additional underwriting at the time of conversion to cover that additional term life rider, but it is fully convertible and you can do that now. And this is good for a number of reasons. One, for the client who already had the IUL, the difference between what he's putting into his IUL and the cost of the term policy that we are presenting to him is a little over $400 a month for the same amount of death benefit, which will get him out of debt faster. In terms of the other family that we're trying to protect, they cannot get out of debt right now. It might be 2 to 3 years before they're ready to start that bank. So having that, but they've got kids. So, they live somewhere, they have children. They need to protect their lifestyle right now. So having a term that is convertible to a bank later on is going to be a huge benefit to this family. And in both cases, what's awesome about this is that it's fully convertible anytime within 5 years, and you keep the original rating issued. So if on the term they're issued a preferred plus rating, and I don't know, maybe they have a second child, maybe they develop a thyroid condition, I don't know. Anything could happen between now and conversion. They maintain that rating. They will keep that rating when the conversion happens, so that when they do actually start their bank, they're building cash value faster based on a rating that happened when they were younger, when they were possibly in better condition, and they can carry that rating with them. Does that make sense?
Yep.
Anybody?
Yes, it makes sense.
Okay, so yes, that is something very much that is available and that we can take advantage of, because when we're writing that term life policy for that family, we've kind of got them in the loop now. They have a product. So when they're ready, do you think they're going to check in with us on a regular basis to say, I'm paying off my debt, I am working toward this bank? Because you've already pulled them in. You've got them in with one product that you have made money on. But when they're ready, they're going to come back. It's not going to be this vague, you're going to drip on them every 3 to 6 months, being like, are you ready? Are you ready? Are you ready? You've got them in the system. They're going to want it. You're going to drip on them, but it's not going to be nearly as tough as saying, you're not ready for a bank right now. Come back to me when you are. Does that make sense?
Yes.
Because you've got them in your pipeline. You're going to keep building with them as they grow. And at the time of, okay, we want to build this bank now, you're going to do that initial appointment again to make sure that the illustration that you ran, 6 months to 3 years ago is still valid. That, maybe they have gotten a promotion, maybe they make more money, maybe they got an inheritance, and you're going to have to rerun that illustration to make sure that the bank that you built then still is fitting their needs now. So, any other questions? So I know that it has come up recently that there was a question about how long before you can take a loan against a policy, and it is 10 days. But that is something to keep in mind, that just because you can doesn't necessarily mean you should. So especially when you're working with smaller banks, taking a loan immediately against that that policy, you want to make sure that the reasons for taking that loan are going to continue to achieve their financial goals. So if they are using the loan against the policy to pay for the policy, or if they are trying to immediately fund lifestyle with it, or if they are trying to make an investment that they're trying to use the payoff from that investment to make the next year's contribution to their bank, these are red flags that maybe they're not ready for the bank in the first place, but they can take a policy loan within 10 days of approval. Examples where that might be useful. You've got a family making $120,000 a year, and they've got a lump sum that they want to put in of $50,000, and they have a kid starting school next semester. So they need to pay the fees for school. Yeah, that is going to sustain itself. And they probably have a plan to start, taking that that $800 a month when the kid goes off to college, that they're no longer spending on their kid, and taking that $800 a month to pay themselves back. But they've built the bank to make sure that they can do that. That would make sense at that point. Does that distinction make sense to people?
Yes.
Okay. So do we have any other questions? I know there's been a lot going on lately with Life Plan 360, with any of the other stuff that we've talked about, with building a plan, with building a policy, with financial concepts that we've talked about, APR versus yields, anything.
Do we have a way to calculate the effective interest rate that a person gets on their policy?
Yes, I still need to look that up. I haven't had a chance to call. They were closed this week, so Forster's.
It should be open today, I think.
I think you're right. I can probably call them this afternoon. How to calculate annual. Yeah, great. To be quite honest with you, though, the only people that have ever asked me that question are agents. I've never gotten that question from a client.
Well, my client asked me.
Really? Okay.
Yes.
So, I mean, including dividends, the average is about 5.5%.
Is that compounded monthly?
I believe it's compounded annually, but I can double check. When is a dividend compounded? Yeah,
Now,
the dividends are paid on an annual basis.
The dividend is different from the interest rate, though. I guess is the interest rate compounded monthly?
Okay. Interest compounded monthly. Okay, I'll find out.
Yeah, I got an illustration I need to get your input on.
Anything in particular?
Yeah, it's something we have to do at the call.
Okay. Any other questions? Does anybody have a client that they need help with a build?
Yes, that's the illustration I'm talking about now. It's a
I mean,
client.
we can use that as an example if you'd like.
No, it's up to you.
Okay. So I've got 14 million things open because I was just on a call with a client. So my apologies while I figure out where my software is. Okay. Illustrations.
I can send you the illustration I have so far.
All right, so I'm just gonna share my screen. Okay. So what state is this for?
Georgia.
Georgia. EF Georgia. Okay. Avengers. Male or female?
Male.
And do you have the date of birth?
Dude, but not in front of me. He's 49.
He's 49.
Yeah, let me open up my browser.
And I'm assuming that he's a non-smoker.
He is,
Okay.
and he takes no prescriptions.
Okay. So we're gonna put this in as a medical. Scoot over to the death benefit and funding.
Now, the rate's better with medical as opposed to non-medical, because we were thinking he'd go non-medical
Why were you thinking he'd go non-medical?
because it's faster.
Because it's faster. Okay. So we'll hold that thought.
That was the only reason.
But is he trying to use this as a bank?
Yes.
Okay. Because the build I use for well, let me see what I can do with this. We're gonna run the medical first and show the difference. So the FPUA permanent term blend non-mech based solve.
Hold on, let me put my glasses on.
Okay. What is he looking to contribute? First off, is it monthly or annually?
His paying premiums monthly.
Okay. And what are we putting in on a monthly basis?
$500.
500 a month. Okay. He's 49. Is he married? Does he have kids?
No, and no.
No and no. Okay. Is there any additional lump sum?
Not that I'm aware of at the moment, but I think it is, but he hasn't told me that yet.
You think there is, but he hasn't told you that yet. So why do you think there is?
Because he kind of alluded that he has some money that he might want to put in there.
Okay. So if he has greater than $6,000 in cash that he wants to put in, I would probably have this policy pay annually. It decreases the internal cost. So we're going to leave it as a 10-year term. We don't have any additional lump sum, and we're going to take a look at the at a glance. So I always look at year 10 to start. So we've put in $60,000 at that point. We have $56,000 in cash value, so it doesn't quite break even at that point. And our death benefit is $315,000. The following year, the term rider falls off, and we have $174,000 of whole life death benefit. So we put in, so it breaks even, I think, year 11.
That's about right.
It's about right. So it's slightly longer than I would like, but at his age, that's not that bad. Okay, so now we're gonna take a look at a non-med. So we go back to client. Non-med. Let me just make sure that it's coming across. Check out the adequates. I don't usually run them this way. Contract premium. What did we have it as the other one? Give me 1 second. I don't usually run this way. Run them this way. I'll figure it out. So our initial face amount is $50,000. And that gives us what, 150 term?
Why did you choose 150?
Because it's a 75% blend. So if the total death benefit is 200 and 50% or 25% is whole life, and that is $50,000, then we have $150,000 of term.
Say it one more time.
Okay. So we know that day one, the death benefit is $200,000 because this is the end of year one death benefit. Okay. So we know that 75% of this death benefit is term.
Oh, I see.
We see that the initial face amount is $50,000. That's whole life. Therefore, the rest of the initial death benefit is $150,000 of term. Does that make sense?
Right, because the total death benefit is over 200.
Yep. So we're going to go back to client. We're going to make this a non-med. Death benefit and funding. Specified death benefit. Minute term blend base sol. Actually, we might go this way. Permanent term blend monthly. Yeah, that's not building cash value that we want. Okay. Specified death benefit. So the face amount is going to be $50,000.
Mm-hmm.
And then we're going to come over to riders.
You don't want to do the MEC avoidance? Oh, you did.
Yeah, it happens automatically. 150. Let's go. Okay. Yeah, I never build them out this way, to be quite honest with you. Data petitions. At a glance. Yeah, it doesn't even let you put in the full $6,000. So I'm going to say that you're going to have to run it as a medical. Does that make
Sure.
sense?
Yeah, where does it not? Show me where it's not letting you put in the 6,000?
Contract premium is $1,800 annually.
Oh,
It's absolutely not letting me put it in. It won't let me add the paid up additions rider on a non-med. So I've tried it a couple of different ways. It's not working. So, because we tried we've tried the permanent term blend face solve, we've tried the specified premium face solve. Let me see if that one does better cash value. At a glance. I mean, this one has better cash value, but it's certainly not anywhere close to breaking even at year 10. It's like half. Because this one does not have a paid up additions rider, it won't let me add it.
okay. That's what I was running into. I couldn't figure out how to do it.
Yeah, it's not gonna let you like do a medical. It'll be far more beneficial to the client. So yeah, as long as they're in decent health, they feel that they could pass medical, they'll be in much better shape in terms of being able to build that out. Does that make sense?
Yes.
Okay. Does anybody have any other questions? Anybody? So I see a couple of new names. House of Callaway, thank you for joining us. If you have any questions, please feel free to jump in. You may or may not have seen past trainings, but we're very much in participation mode here. So if anybody has any questions, if they need any help with a build for a client, a way to respond to something that a client said, any objections that they've received they're concerned about. We actually had a client recently that they couldn't get their head around the fact that we were suggesting that they input $18,000 a year. And this was based off something that they had said, that they were going to pay off a certain debt by February. Well, the debt's $12,000. So November, December, January, February, 4 months into $12,000 is $3,000 a month. So splitting that in half for each one of the couple, each policy would be putting in $18,000 a year. Could not get past that because they were concerned that if their spouse passed, that they would not be able to afford their mortgage payment, which is rather high. But if their spouse passed, how long would $500,000 pay for that mortgage payment? So little food for thought when you're talking to clients and your client has a particular objection because and really what we were trying to illustrate is the concept, the banking concept, that this is possible. We're not suggesting that you necessarily do this, but this is possible. And we can adjust the numbers to fit the actual situation. So something that I have determined in my experience dealing with clients is that people would rather talk to you about their medical history than about their finances. That is a fact. They are much more open with their medical history than they are with their finances. And we can debate the psychology behind that forever. But personally, I feel that their medical history is half chance, where they feel that their finance is fully their responsibility and they don't want to show people what they feel are their shortcomings. They also don't want to show people their successes. They're afraid to brag too much. So people don't want to talk about their finances. And I've actually said that to people when they're like hedging about certain things, or just make that joke that, you know what, it's fine. Like we're in a safe space. I have a fiduciary responsibility to do what's in your best interest. And quite frankly, people would rather talk about their medical history than their finances. It's just, we don't talk about it. We don't talk about it. So when you have a client that is playing everything very close to the vest, you have to build that rapport to break through that wall. Does that make sense to people?
Absolutely.
Okay. And that's something that I say to people all the time, whether we are building the plan, whether we are going through an illustration, that these are all fake numbers. Nothing is written in stone. Everything can be changed. We're just going through to see what is possible. And then we're going to choose what you're actually going to do, or you are going to choose what you're actually going to do. So, okay.
I have a quick question.
Yeah.
So I know we talk a lot about policy build outs and how we, get them started and stuff.
Yep.
And I know it's still kind of new, and I don't know if you've even talked to someone, maybe, anyone else in the industry, but what happens at the end? Like, how do we, I know we talked about earlier, taking them to the reduced paid up if they didn't want to pay. So, but like when a person, what's the end game? Like, I wouldn't say end game, but I mean, like if a person passes away and we know that this is paid out to their beneficiary. But I remember a call sometime back with John had brought up an idea of saying, you're dealing with the client now, but once they pass on and now they have children left, what's the has anybody ever brought that up or even thought about, like, what's the transition? Can you take that money instead of them just paying the money out directly to them? Can they roll it over and transfer it into them a bank, or like?
Okay, so that process would be a little bit different because it is a contract. A life insurance policy is a contract. So that contract says that this person dies on such and such a day. This will be the death benefit that will be paid to the following people written into this contract. So that is where we as financial consultants step in, and we're dealing with those people because their parents, they're the beneficiary, so their parents were our clients, and we can at that point express our sincere sympathy for their loss. We want to let them know that this was left to them as the beneficiary of their parents' policy, and that you would be happy when they are ready. A wake or a funeral is not a good time to go over this, to go over what that means for them, and possibly helping them determine the best way to proceed to make sure that the benefit from what their parents have left them benefits them in the best way. And chances are, if their parents were our clients, depending on how long we have had them as clients, we may have already talked to these people. So they may already have banks of their own, and we're working with assets and other things to make sure that the family is best taken care of.
Gotcha.
Does that make sense?
Mm-hmm. Yeah.
So yeah,
I don't know if it was like anything like specific that we needed to do at that point.
Not really. It's kind of, I mean, even if the agent of record is unavailable, the beneficiary is still going to receive the benefit.
Right.
It's just kind of it's a nice touch when the financial consultant reaches out to the family and says, hey, your parents were my clients for many years. I've heard a lot about you. I'm very sorry for your loss. You give that like personal connection. And you're also rapport building at that point. And sometimes you've met with these people, sometimes you haven't, but you can do the rapport building at that point. And it depends on what type of client they were. Not everybody is going to be a banking client. Sometimes these people that you're delivering a death benefit to were retirement clients. Maybe you're delivering a death benefit of an annuity. And at that point, you can help them with figuring out how to best benefit from their inheritance. So yeah, that's a great way to open the door, is always deliver that personal service. And be sincere. Like you don't have to. I never go in with a sales attitude. I quite frankly would not describe myself as a salesperson. I'm an educator. I'm a financial consultant. But do I sell? No, I don't. I help people buy. So it's a technicality maybe, but in my personal opinion, it's an important one, because how many of us like being sold? I know I don't.
No, hate it.
But we all like buying, right? Like we
Girl,
get that
yes,
little,
yes, we all want
yeah,
to buy. I like to buy.
we like that jolt of, hey, I got something shiny and new. But we also like to buy things that are to our benefit. Like when the last time you went car shopping, how many cars did you look at before you bought one? What did you care about that car? You cared about the cost. You cared about the gas mileage. You cared about the trunk space. You cared about, is this car new? What is it going to cost me in maintenance? There are certain things that you want to know about the car. You want to know, is there a blind spot that's going to be difficult for me because I'm short? These are all things that we want to know about a car. But when we're talking about life insurance, which is protecting our family and in some cases ourselves, we don't ask these questions. Why don't we? Because we don't know to ask them, which is why most people are very, very uncomfortable buying insurance. As soon as you say that you are in insurance sales, they cannot get out of the elevator fast enough. People will get off at a floor that they are not going to just to get away from you. I never say that I'm in sales. I never use the word insurance until we're at that point where people have already decided that they want the plan that we put together. That's when I bring up the word insurance. They have chosen it before I have suggested it. And then I help them through the process of buying something that they have decided that they want. Does that make sense?
Yes. Mm-hmm.
Okay.
Mm-hmm.
Does that answer your question?
Yes. Yeah, it kind of, yeah, I was thinking like maybe I do understand that the part of it talking about like being, nice and, giving that final touch to them. But I was thinking maybe from the standpoint of not really selling them, like not, I was thinking from the standpoint of they're getting ready to get a chunk of money into their hands. Like, do we offer them, I guess it's going to be a conversation. It's not like a particular thing. I was thinking from the standpoint of, hey, we're getting ready to put a chunk of money into your hands. Do you want to, look at some things that you can set up for yourself, that type of thing.
Yeah.
But
yes, that is always a
because
conversation.
that
That is
to me,
always
it
a
makes
conversation.
sense to, not, I mean, people can have money if they need it, but if it's not needed and they can build something great for themselves that their parents kind of started off, like boosted them off with, like showing them what they can roll that into without, of course, getting themselves in trouble, because once it hits their account,
it's spent before it hits their account.
Right. That's exactly.
That's Parkinson's law number 3. Any
Right.
expected money will be spent before you get it.
Yeah, and that's
So
that's what I was thinking from the standpoint of just giving them, because I think a lot of times too, I didn't realize that once I got into insurance, like when people get their the beneficiaries get their money, they have options. They don't have to take the lump. They can put it into something else, or they can, get a checkbook for it and write checks to pay for things that they need to. Like, you just don't have to dump that type of money into people's hands, because again, they, like you said, Parkinson's law, they
right,
don't know what to do with it. They go and spend it. So just to try to help them say, hey, we know you're going to spend some of it, but can you take a chunk of it and put it here so you can see, something that's going to help you, later on, where you're not,
yeah,
thinking about it now.
yeah,
Yeah.
yeah. And that is the conversation that you you want it to benefit the client, and you want to make sure that they have what they need, that their needs are met, and that this inheritance from their parents is going to help them achieve their needs, wants, desires. And you would be very happy to walk them through to make sure that they are able to do that. That they're making, that obviously you want to make sure, they want to, they haven't taken a vacation in 5 years because they were taking care of mom and dad in their old age, and all of a sudden they are now, their parents have passed, they have the time, freedom to take that vacation. Well, great. How much money do you want to chunk out of this to take your best vacation that you want to do that? Okay, great. So we're going to set that aside, and you have some repairs that you need to make on your house. So we're going to do that and do that. Okay, so now you have this other money. Have you thought about a way to, protect your life, protect your lifestyle, protect your family going forward? Have we thought about these things? Well, let's talk about that. Let's sit down. Let's make sure that those needs, goals, wants, desires are being achieved, are being met.
Okay, so you're almost like kind of structuring the questions around kind of how, like, we do LP 360, just kind of
Yep.
pulling that information out of them to be able to
Yep.
build what you need. Yeah.
Yep.
That's good.
It's a cycle.
Yeah.
It starts again.
Right.
And the difference is that now we know what we're starting with.
Right.
And maybe this person has other things that they'd like to add to this, that they have an inheritance from the other side that we don't know about. Maybe they have, a 401k or a Roth or a mutual fund, or we don't know how much money they're making. We don't know how much money they're saving a month. This $100,000 or whatever it is that they just inherited from their parents might be their lump sum starting point. And maybe they're like, oh, this is how I'm going to pay for my kid to go to college. And you're going to sit down and be like, step back. Let's take a look at this.
Right. Gotcha.
Because this is a great opportunity for us to get in with that client and start the cycle again.
Right.
Does that make sense?
That's good.
So it's the same conversation. It's just slightly different the way you start it.
Yeah, at least now you go in knowing there's something there to go with versus, hey, let me pull out of let me pull all these things out of you to find out what's there. Yeah.
Right. Because if you get $100,000 and you're paying for your kid to go to college, and it is $20,000 a year, that money is gone.
All right.
It is done. And now you maybe have a second child that is also going to want to go to college, and you have no idea how you're paying for that second child to go to college.
All right.
But that's the way people think. They're like, oh, I have this inheritance, I can now pay for my kids to go to college. But you can't.
All right.
So it's a matter of figuring out all of the mechanics.
Right.
So hopefully that's helpful.
Yeah, it is. Yeah, because I had a client before that I was talking to her. She herself didn't have anything, but her mom had left her money and a financial advisor, and
Mhm.
she was depending on that money. It was like 100 grand. She was depending on that. And then she had her mom had set up 529s for her kids, but it was something to where she couldn't well, one of her kids didn't know. He had just graduated. He didn't know what he wanted to do. The other one, he still had a while, but she, at the same time, she didn't want to touch the money for some reason. She didn't want to use that to, she wanted to figure out a way to pay for it, but she didn't want to use anything that she had. So I've had that happen before where a customer, they wanted to like figure out another way. And it was like, well, you're giving me nothing to, you
Nothing to work
have
with.
stuff, but you're giving me nothing to work with. So it's
Yeah.
kind of hard to say, oh yeah, we can, you have 100,000 sitting here, we can take that, and that's a starting point. Maybe by the time you get to the second kid, you'll be ready. But no, she didn't want to touch any of that. She was like, I want that for them. And I'm like, okay,
Yep.
but how are we gonna start something else with zero? Like we got Magoo said.
Yeah. 529s are tough because people
Mhm.
are afraid to run out of money in them.
Right.
And I've seen it where you have a household that has 529s and they have really broken the bank to put the first kid through college without touching the 529
Mhm.
because they're afraid to run out of money in the 529.
All right.
And then the second kid starts to go to college, and then the third kid decides that they're not going to go to college.
Yeah.
And they've got $100,000 in this 529
Just sitting there.
that can't be used for another purpose.
No. Mm-mm.
So, it's that very, okay, you have this 529, you don't want to cannibalize it for your life plan. Why aren't you spending it as soon as possible on your child's education so that it doesn't penalize you in subsequent years on FAFSA?
Yeah.
So yeah, that's a different topic of
Mhm.
discussion, but like,
Yeah.
why wouldn't you get rid of it as soon as possible if you know that you're not getting free money because you have a 529?
All right. Well.
So that's another conversation.
Mhm. Thank you.
Not a problem. So we've got about 5 or so minutes left. Does anybody else have questions? Okay. So again, everybody, keep in mind the contests that we have going on. There are a couple of people both on this call and not on this call that that I've been helping with various clients to help them get into the contests. Make sure that you're emailing me so that I am watching your sales production to make sure that you're involved in the contests. Email me if you have questions, guys. Please feel free to reach out. I want to make sure that you guys are succeeding and that you have what you need to succeed. And also, I'm going to give you guys the same homework this week that I gave last week, and that is very simple. I need you guys to send me an email. My email is kroads@icanfinancial.com. So I'm going to put that in the chat now. kroads@icanfinancial.com. Don't reply to the marketing emails. Email me here. So I want you guys to send me an email, and what I want you to tell me is what you need to learn at boot camp to make it personally worth it for you to go. I'll say that again. What do you need to learn at boot camp for it to be personally worth it for you to go? And boot camp is March 1st through the 3rd. It's a Wednesday, Thursday, Friday in Dallas, Texas. And it's going to be a great time, and we're going to have a lot of learning going on. But yeah, I really need you guys to start doing the homework assignments. I got precious few responses for a fairly simple task. This really should take you 5 minutes or less to let me know what it is that you need to learn. Because I want to tailor boot camp to the people that are going. I need to know what it is that you guys are missing, that you're not being as successful as you would like to be. So when building the modules, that's what I need to know. So with that, are there any other last minute questions before we adjourn for the day? Okay, and with that, I say thank you guys for coming. I know it's a different day and different time, and that it would be a small group. And happy Thanksgiving, and I will see you all a week from tomorrow. It will be Thursday at the normal time, which I believe is the 29th? Nope, it's December 1st. So I will see you guys next month, which is next week. But December 1st, noon Eastern, 11 Central, 10 Mountain Time, and 9 a.m. West Coast. So, okay.
Thank you, Petra.
Thank
Happy
you.
Thanksgiving to you.
Thanksgiving.
Bye, guys.